Sterlite Tech will acquire 100% stake in Impact Data Solutions for an enterprise value of 106 crore rupees. So how will this acquisition impact its balance sheet position? To take us through the details of the deal, the group's CEO, Anand Agarwal, is joining us on the show right now. Mr. Agarwal, thanks very much for taking out the time. A relatively smaller acquisition, 106 crores in terms of enterprise value. I believe it won't have too much of an impact on the revenues or EBITDA, but just to quantify for the sake of the record, could you just tell us how much would the impact be?
Sure. Good morning, Devina. This for us is IDS for us is a capability acquisition. It provides us design and deployment capabilities for inside data centers. So you're absolutely right when you say that it won't have too much impact either on our revenue or balance sheet in the short term. But we see this capability providing us an entry into the large cloud data center opportunity, which we are seeing globally becoming extremely relevant. So both the hyperscale data centers which cloud companies are building, as well as the edge data centers that they are building. So this acquisition provides on the STL platform, this capability gives us an access to that large opportunity.
How big is that addressable market for you?
So currently we believe this market overall globally would be of the order of 7 to 8 billion US. And it's growing very rapidly. It's the entire data center build market, and within this is the infrastructure piece which we are focusing on.
So is this on the back of your focus on increasing, your services part of your portfolio, because you've got some headwinds coming in from your product portfolio?
It's essentially our focus on increasing our global addressable market size. So we have 4 customer segments. We have the telecom service providers, we have the citizen networks, we have large enterprises, and we have cloud companies. So within cloud companies, our addressable market till date was essentially just the network that was being built between the 2 data centers. With this acquisition, we go inside the data center as well and start playing a significant role in the capex that goes inside the data center. So it provides an opportunity for our products business, our services offering to provide a consolidated, integrated solutions, both for inside data centers as well as outside data centers, and primarily focused on cloud companies.
So, you earlier on stated that you are looking at acquisitions to make sure that you meet the goal of expanding the addressable market to, I think, $75 billion by 2023. Are you a long shot away from that?
No, we are moving clearly on that direction. We are moving clearly as per our strategy. So we acquired a software company a couple of years ago. We acquired a products company in Europe last year. With this acquisition, these are all acquisitions which are small in size, between say 100 to 200, 250 crores, but each of them provide us that capability for addressal of that market. So clearly this increases our addressable market by another, as I said, $7 to $8 billion. And 75 billion is a goal that we intend to achieve by 2023, and we are absolutely on the path for that.
Okay, let's talk about translation in terms of revenue CAGR, and are you looking at a translation of earnings growth to the tune of about 9-10%, or maybe you'll target some more?
This essentially, are you talking about the particular acquisition or the STL as a whole?
As a whole, including all the acquisitions, okay, and when the synergies play out, and keeping in mind a consolidated entity.
Sure. So on a consolidated basis, we have grown rapidly over the last few years. 2019, we are seeing clearly in terms of it's more of a capex consolidation on the telecom side that we are seeing. And the other areas like cloud, the other areas like enterprises continues to be exciting for us. In terms of clear projections of how the year will turn out to be, Since we are very close to the Q2 results, I think we'll give an indication of that post our Q2 results. But we are well on our path as what we have stated.
All right. And you've been constantly growing your order book position as well, despite facing challenges in the product business. Is that also going on track?
The order book is largely going on track. Yeah. As I said, 2019 is slower than the previous years that we have seen, primarily due to capex slowdown that we have seen in China, India, and now moving on to Europe as well. But overall, as a company, we are largely on track.
When does the additional volumes from the optic fiber cable expansion to about the 33 million kilometers start to kick in for you?
That expansion essentially will finish by June of next year, 2020. So a significant part of that will start showing up in FY21.
Okay. Also, any risks that you're facing in terms of probably, moderating revenue trajectory, which could be on the back of, 5G related capex getting pushed back, Chinese telcos posing a key risk, anything on those lines which you feel could be a hindrance?
So as I said, 2019 overall, what we are seeing globally, there is a bit of consolidation on capex happening from most of the customers, especially on the telecom side. We saw it in China, we are seeing it in India currently. And we are using our current order book to kind of tide through the current situation. But on a holistic level, we continue to be very overall positive and bullish as we move forward.
Okay. Now, just, are you intending to take your exposure in the services business to what level? I believe services contribute about 45% to the order book. Are you looking at increasing that contribution in a big way? And then also because of the fact that services, in terms of margins is slightly more compressed than the product side. So will that impact the overall margins and squeeze that a bit from low teens to probably under 20? Low 20s to under 20? Our services business in terms of revenue mix has been closer to 35% till date, while the order book is closer to 45 to 50%. So as the mix of services keeps increasing, the margin may go towards 18 to 20%, and that's been our direction as well as our guidance. At the same time, the services business has a better return on capital deployed than the products business. So on a mix perspective, I think we'll see the right mix of margins and return on capital. Okay, got that. So could you talk a little bit more about, whether or not you do see the demand pickup coming in on the optic fiber side? When do you see that picking up? Because China has remained flat, and the expectations are that you may not see a really meaningful pickup till at least maybe next year onwards.
Sure. So this year for China, we've seen the two tenders happening of China Mobile and China Telecom over the last four months or so. So this year is on an optical fiber front globally, it's going to be sort of a flat year. 2020, the projections are that the growth should be back because some of the leading markets, 5G is moving on to commercial deployment, and that should spur up fiber demand. So 2019 overall from fiber as well as global capex is a consolidation and a flattish year.
Okay, and what about prices? Where do you see that headed?
Prices have been pretty stable over the last, we saw a decline happening between November and February of this year, November last year till February. Since February, March, it has been pretty stable throughout global.
Do you feel China prices have bottomed out?
What we are seeing, it's been in the same range since February, March or so.
All right, Mr. Agarwal, thanks very much for joining us. Congratulations on the acquisition. Appreciate you speaking about that with us here on the platform.
Sure, thanks.
All right, moving on. The corporate tax cut is a kindly help to realtors. That's off the tax savings of nearly 5% is used to cut the large debt on their balance sheets. Debt reduction will help secure a better credit rating and make it easier to secure funds. So how are realtors planning to make the most of the tax relief? Let's ask Mr. Atul Goyal of Brigade Enterprises. Mr. Goyal, thanks very much for taking off the time and speaking with us. Let's start off first with the big benefit that comes in for Brigade Enterprises. First, if you could quantify that for us. And secondly, if you will actually go and avail of this effective tax rate of 25%.
Yeah, so we are analyzing the tax benefit for us. See, actually, our business is more into mid-income affordable housing, and as you know, of in affordable housing, you have an 80IB benefit, and as well as we have SEZ properties which are being constructed, and there'll be an SEZ benefit will be available. So yes, if you see in Brigade, tax rate right now is around 23-24%. It's only because we were 80IB benefits from our earlier projects. We have some more projects of 80IB which is going to come in Brigade. So we are analyzing that as to if there is a more profit for them and it's beneficial to into the current tax. Will go into that because this 22% you can opt anytime next year, or maybe the time when you stop availing 80IB benefits. But yes, some of the subsidiaries we don't have affordable housing, it will be benefit. They'll be benefit and will be shift to 22%. Maximum companies which are on SEZ platform. It doesn't make right sense to 22% because the 100% profit exempt. There may be some MAT which later on when we get a depreciation low down, then maybe we can take the MAT credit later on and then shift to 22%. So I think for us it is a mixed bag right now. Mainly some of the will move 22%, but luckily we may into the current tax. BL we are analyzing, and maybe by year end, because we are if you 22%, you should have a 5-6 years calculations of profit which you are going to the launches. So we are, and I think BL we may decide at the moment to go on 22% or not.
Okay, so like you said, you're still analyzing the numbers, but the first impression that one gets, is, especially from a real estate standpoint, is if there is any incremental savings, then that savings can be used immediately to bring down debt, which affects the credit rating positively, which again then makes financing for the future that much more easy. Is that a route that you would also be contemplating?
Yeah, definitely. This will, if we tax saving, there is a definitely and will definitely be used to pay down the debt so that credit rating of developers go up. Yes, I think if we also have that benefit, we'll definitely try to do that.
What is the current debt on the books? If you could highlight that for us.
We have around 3,000. Yeah, we have around 3,100 crores of debt in our books, but maximum of them is in leasing portfolio, because there are two large capex projects which is being made in SEZ in joint with GIC. So I think half of our debt is in the lease business, and if you see around 15% is in LRDs or profit backed hotels, which and it's not affecting the BL cash flows.
Okay, let's talk a little bit more about the business now, sir, and what is the game plan with regards to the annuity business?
So annuity business, see, we already have a 3.3 million square feet of ready properties and leased. We are doing around 5.5% of 5.5 million of commercial space in the SEZ area, and again we have one more land where we can do 2.07 to 2. So I think this is earlier. This is right now. Concentrating on building these properties and leasing this out. Once we are through this, maybe then we can look at monetizing, maybe through REITs or some other possible ways. But I think it is at least 4 years away right now for BL.
All right, but But your target growth rate would be what, 18 to 20% for the annuity business on a yearly basis?
Yeah, definitely. Definitely, it will be around 18 to 20%.
All right, and when you say you're going to consider REITs, is that also some time away, or it could happen sooner rather than later?
So as I said, REITs are at least 4 years away. Okay. We want to come into the market only when we have at least sizable number of properties, at least 10 million. So I think between 3 to 4 years we'll be into the 10 million category and a revenue of around 1,000 crores. I think that will be the apt time to come into the REIT that time.
What is your intention with regards to the residential business in terms of how much you intend to scale it up? And, we were pegging a growth rate of 33% for the residential business in FY20. Is that realistic enough?
Yeah, see, I think there is a talk of slowdown, but since we are into real estate, mid-income housing and affordable housing, they have been doing well. I think further there is a external benchmarking which banks are going to do on home loans, and SBI is already announced from 1st October. So I think this should also fuel demand in the economy, because you will be seeing one of the lowest home loan rates in decades coming in. And thirdly is that there is a consolidation happening into the developers, and the original, or you can say developers, A-grade developers are garnering more business, more sales. And third thing is that if you have a right price, right place, and right size, so properties are still selling. So Brigade as such has been in middle income housing and affordable housing. So I think demand is there, and it should grow. As for luxury housing, yes, the demand is slow, and that will continue to slow. But we are not much in luxury housing. Around 7-8% of our total inventory is in luxury housing. So I think we will maintain whatever guidance we had given of around 4 million this year, and we are in line with in Q2 also, and I think we should achieve that.
Okay, just one two-part question, not related, but we're running out of time, so just squeezing that in. Firstly, in terms of funding requirements at your end, is there any pressure at all? And secondly, I mean, while maybe not applicable to you, but what did you make of the finance minister's, announcement with regards to a special window for stalled projects and, a contribution that the government will make, and then as well as the private sector to match that?
First about the financing, I don't think so we are facing any issues. Banks are coming forward to lend to Grade A developers who have a good rating of A and above, and I think we have a quite traction from banks, and we are one of the PSU bankers are one of our larger lenders as well as private banks, and we have a very nominal NBFC portfolio. So I don't think so we are taking and we are looking at any issue in that. Yeah, interest rate hike has been there in last 1 year, but still at 9.7 we are competitive in the market. As far as the stress fund is concerned, I think the problem is that, see, today you have a completed inventory of 1.84 lakh homes in India. Out of which 1.24 lakh homes are in Delhi NCR, and most of them are into NCLT and NPAs. So this stress fund does not cover those NCLT and NPAs. So I think that government should look into, because then only they can help the developers. It is still an announcement. We are still, there has to be a blueprint which has to come, and I think we'll look into the blueprint and see. But it's a good effort by the government. I think they should do it very fast. Otherwise, other stressed developers may also go into NPA or into the NCLT, and problem may compound. I think, but it will help other than NCR builders, where people have taken loan and they have at least completed 60-70% of the project, but they have not been able to sell because the market and banks are not willing to lend, or if they have an NBFC loan, there is a problem. So they are definitely last mile funding and help to complete their projects.
Got that. Mr. Goyal, it was a pleasure chatting with you and getting your thoughts. Thank you so very much for joining us this morning.
Thank you. Thank you.
And obviously, he did say that the stress fund, the timing of it is more important before more of those stress developers go into NCLT. Markets are doing well, holding on to early morning gains. In fact, expanded on that, almost 1% now for the Nifty 50, 11,550. Bank Nifty is up a full 1.5%. But we're going to wrap Indian Open right here. Lots more market action continues on the other side with the F&O show.